4.39%, that is what the 10-year Treasury is yielding right now. And if you have spent any time studying how gold behaves in rate environments, you already know what that number is supposed to mean. It is supposed to mean gold gets sold hard, consistently, because when a risk-free government bond pays you 4.39% annually, the argument for holding a metal that pays you nothing becomes extremely difficult to make. And yet gold closed the week at $4,491.15, not $3,200, not $3,800, $4,491, within reach of a level that would have sounded like fiction 2 years ago. So either the textbook is wrong or something else is happening underneath the surface of this market that the headline numbers are not showing you. My name is John, 15 years in currency and commodity markets before I ever picked up a camera. I've watched the relationship between gold and interest rates play out across multiple cycles, and what is happening right now is not normal, not impossible, but not normal. If you are holding gold physical, ETF, mining stocks, or in a pension, you need to understand exactly what it means. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. Everything I show you today comes from publicly available sources, and I will name every one as we go. 3 things you are walking away with today: why gold is defying the yield playbook, what the Shanghai discount tells us about who is actually buying, and how to think about your own position in the middle of a setup that genuinely has 2 valid outcomes. Last week I told you to watch the Sunday evening Globex open on silver, specifically whether COMEX front-month silver futures would gap higher to reflect the $13.05 Shanghai premium, whether dollar strength would override the physical signal. I will be straight with you about what happened, and the answer feeds directly into what I am about to show you on gold today, because the 2 stories are connected in a way most commentary this week has completely missed. Make sure you stay with me through the 3 lanes section, because that connection is where the real insight lives. The silver setup and the gold setup together tell a story that neither tells alone. Let me give you the exact picture on gold, because the numbers themselves tell a story before I add a single word of analysis. Gold USD closed the week at $4,491.15. The 10-year US Treasury yield ended at 4.39%, and the dollar index came in at 99.65. Now here is the number that should genuinely make you stop. Shanghai gold is currently trading at approximately $4,207.71. That is not a premium, that is a discount. Shanghai, one of the world's largest physical gold markets, pricing gold nearly $283 lower than Western spot. Last week on this channel, Shanghai was paying a $13.05 premium over Western silver prices, suggesting Eastern physical demand was running hot while Western paper markets were selling. Now flip that picture completely on gold. The East is at a discount while the West holds near $4,500, same week, same macro environment. 2 completely opposite East-West dynamics. Drop a comment right now. Are you currently holding gold, silver, or both, and has this week's price action changed how you are thinking about your allocation? The comment section here becomes a real-time sentiment tracker, and I read every single one. The standard relationship between gold and interest rates works like this: when real yields rise significantly, gold tends to fall because gold competes with bonds for capital. If a 10-year Treasury pays you 4.39% per year with the full backing of the US government and gold pays you 0, money flows toward the bond. This pattern played out clearly through 2022 and into 2023 when the Fed's aggressive rate hiking cycle pushed gold down from its highs. So when I tell you gold is currently at $4,491 with the 10-year at 4.39%, either real yields are not as high as the nominal figure suggests, meaning inflation expectations keep real rates lower than the headline implies, or the buyers holding gold near $4,500 are not buying it for the reasons rates analysis normally captures. Think of it like a compass in a room with 2 magnets. The needle is supposed to point at the strongest magnetic source, but if 2 magnets pull in different directions, the needle settles somewhere between them. Western institutional buying is pulling gold toward $4,500 and beyond, while the rate environment and the dollar are pulling it back. The needle is sitting at $4,491, and that is the battlefield. When Shanghai trades at a $283 discount to Western spot, it means Eastern retail and institutional buyers are not chasing gold at current prices. They are either waiting for a pullback or local market dynamics, including currency factors, are creating a structural discount that does not reflect global scarcity. The contrast with silver last week is stark. Silver saw a massive Shanghai premium, Eastern buyers paying up for physical metal, while gold shows the exact opposite. This tells us the current gold price strength is being driven primarily by Western institutional flows, funds, family offices, sovereign wealth vehicles, not Eastern retail buying or central bank accumulation showing up in spot demand. And here is why that matters for risk. Western institutional flows can reverse faster than Eastern physical accumulation. An institution that bought gold at $4,200 as a macro hedge can rotate that position on a Tuesday morning, selling fast, electronic, and large. If you know someone managing their own pension or SIP trying to make sense of why gold is near $4,500 when everything they learned about rates says it should not be, share this video with them right now. The people who need it most are not always the ones searching for it. The dollar index at 99.65 is the primary anchor on gold right now. The DXY and gold have a well-documented inverse relationship, and at 99.65 the dollar has not broken above 100 with conviction but is close enough to act as a ceiling on gold's near-term upside. The $4,500 psychological level and the DXY at 99.65 are essentially arm wrestling. One wants to go higher, the other is pushing back. The 4.39% yield on the 10-year is doing the same from a different angle. Every basis point higher makes the opportunity cost of holding gold more expensive, and if that yield moves convincingly above 4.5%, the calculus begins to change for Western institutional holders. The bearish scenario flags $4,200 as the key support for a retest if yields push above 4.5%, and that number corresponds closely to where Shanghai is currently pricing gold, meaning a Western correction toward $4,200 would be moving toward convergence with the Eastern discount. Imagine you own a house valued at $450,000 by a Western estate agent, but every Eastern buyer has offered $420,000. The Western valuation is real, someone is paying it, but if the Western buyer walks away, you find out very quickly what the floor actually is. Gold near $4,500 does not exist without a geopolitical context, and this week that context is particularly active. Gold has historically functioned as the asset of last resort during geopolitical stress events, not because of any mystical property, but because it is liquid, globally recognized, and held by institutions specifically. For crisis conditions, when energy infrastructure becomes a geopolitical flashpoint, markets reprice risk rapidly across multiple asset classes simultaneously. Oil moves, bond yields move, currencies move, and gold at elevated levels near $4,500 can gap significantly in either direction. For UK investors, the LBMA's role as global gold price benchmark means London is directly in the flow of any major geopolitical repricing event. If you are holding gold in a SIP or UK-based ETF, your exposure to a Sunday evening gap event is real and worth thinking about before markets reopen. Central banks have been consistent net buyers. While Western spot gold sits near $4,500, they do not buy gold because they think it will go up next Tuesday. They buy it because they want an asset outside the financial system that holds value across crisis conditions, and that is the structural floor underneath the price. Gold does have industrial demand, semiconductor connections, medical devices, aerospace components, high reliability electronics, and any discussion of that demand floor should be understood in the context of AI hardware expansion. The same build-out creating structural silver demand is creating incremental gold demand, smaller in scale but real, and as a secondary support factor, it belongs in the honest picture. Let me show you how I am thinking about this week using the 3 lanes framework. This is how I separate noise from what actually matters. Lane 1 is the paper market. COMEX gold futures trading close to spot, reflecting the same Western institutional bid holding ZO or US near $4,491. The futures curve not showing unusual backwardation or contango that would signal stress in the physical delivery mechanism. The paper market here is orderly, which is itself informative. Lane 2 is the physical market. The Shanghai discount of approximately $283 tells us Eastern physical demand is not stretched at these prices, and London vault activity through the LBMA is the real-time physical barometer for gold. If LBMA vault withdrawals accelerate in the coming week, physical demand is catching up to Western paper prices. If they remain subdued, the Shanghai discount story holds. Lane 3 is the macro lane. Dollar at 99.65, 10-year yield at 4.39%, both headwinds for gold on paper, and yet the price is at $4,491. In 15 years watching these markets, when an asset holds a level it should not be able to hold given the macro environment, it almost always means either the macro analysis is missing a factor, or the smart money knows something about the direction of that environment that the current data has not yet confirmed. When the paper lane is orderly, the physical lane shows an Eastern discount, and the macro lane runs contrary to the price. The historical pattern has been that one signal eventually dominates and forces a resolution. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching. This week, the $4,500 level on ZO or USD at the Monday open. Specifically, does gold open above $4,500 with the first meaningful volume of the week, or does it open below and immediately begin testing the $4,491 close? At $4,500, a whole set of option structures and institutional triggers become active. If gold opens and trades convincingly above that level with volume, the next target is the $4,700 resistance zone, and that move could develop quickly if the DXY simultaneously softens below 99.0. If gold opens flat or lower and the DXY firms toward 100.0, would expect a retest toward 4400-4350 before any fresh attempt at $4,500. This is my one call for the week, John FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. Here is what needs to happen for the optimistic picture to develop. The DXY needs to pull back meaningfully from 99.65 toward 98.0. The 10-year yield needs to stabilize rather than push above 4.5%, and the geopolitical backdrop needs to generate risk-off sentiment that sends institutional money into gold as a safe haven. If those three conditions align, the path to $4,700 is genuinely open. For the cautious picture, the 10-year yield pushes above 4.5% with conviction, the DXY firms toward 100.5 or above, and institutional buyers holding gold near $4,500 begin rotating back into bonds as real yields make the fixed income case more compelling. In that scenario, the $4,200 support becomes the first major test, which is almost exactly where Shanghai is currently pricing gold. Both outcomes are genuinely possible right now. Your job is not to pick one and emotionally commit. Watch the DXY Monday morning, the 10-year yield through Tuesday's session, and whether Shanghai's discount begins to compress or widen, the market will tell you which picture is developing. Before we close, everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here is a recommendation to buy, sell, or hold any asset, and past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. That disclaimer is not a formality, it matters. If you got value from this today, the like button takes 1 second and genuinely helps this channel reach people navigating these markets without all the noise. I want 2 honest answers in the comments. First, has the fact that gold is near $4,500 despite 4.39% yields made you more confident in your position or more nervous about how far it has run? Both answers are valid, and I want to hear from both sides. Second, are you watching the Shanghai gold discount as a warning sign, or do you think Western institutional flows are strong enough to keep gold elevated regardless of what the East is doing? Subscribe. Next week we go directly into how to read LBMA vault data, showing you exactly what the London physical market is signaling in real time and why that data source is one of the most underused tools available to retail investors on both sides of the Atlantic. And if someone in your life is watching gold near $4,500, trying to work out whether this is a historic opportunity or a historic top, share this with them. This is Currency Insider. Know the market, protect your currency.